Joining us now, Jeremy Siegel, professor emeritus of finance at the University of Pennsylvania's Wharton School of Business and chief economist at WisdomTree. And once again, it's good to see you. Happy New Year. Happy holidays, Jeremy.
Thank you, Joe.
Been a good time to be pro-U.S. economy for the past year. Once again, pro-stock market. We're the best economy in the world.
Third and fourth GDP numbers. I mean, we're just getting the fourth. The St. Louis Fed came out with a 3% estimate 2 days before Christmas. Of course, we had that plus 4% for the third quarter. And even with a negative first quarter, that would make 2025 faster growth than the last year of the Biden administration, even with all the chaos with the tariffs.
That is the economic backdrop, obviously, but I was really referring to, what, 19%, 18, I don't know, we may hit 7,000 before the end of the year on the S&P. It's possible. I'm not saying we will. But the third or fourth really good year, third at least. Yeah.
And next year, I think, I know it's been predicted for a long time because the streak of the Mag 7 is really quite unprecedented. But, next year, I think S&P, which is very weighted towards, of course, the tech and Mag 7, might be less than double digits, 5 to 10, still good. The non-Mag 7 could be 10 to 15, with a Mag 7 finally positive, but in the low single digits. Now, of course, it's very difficult to make one-year estimates, but that would be a turnaround, certainly from the last 3 years, but still leading to a very good market in 2026. So it's, I think, a lot of good headwinds, good tailwinds pushing forward. We have bumps. We have 3 bumps in January. We have, of course, another potential government shutdown. We have the Supreme Court perhaps going to announce on what it's decided on tariffs. And we have perhaps finally the announcement from Donald Trump about who our next Fed chairman is going to be. These are very important issues to get through, in addition to what is GDP and what our earnings and what our margins. And we might all get those in January. So it might, and certainly one of them, the shutdown, has to be either solved or extended in that month. And the other two look like they're likely to be announced. So we need to get through some bumps, as I say. But if we can get through those successfully, it still looks like a positive year for me.
Right. A lot of times the default forecast at the beginning of the year is that 7 to 8% long-term average for the S&P. We hear that a lot, and usually it either does a lot more or maybe even a down year. I don't know if people ever forecast a negative year. Can't remember the last time someone did that.
A few do. I mean, when you take a real out of consensus forecast, you're either wrong or you become a hero, and you can decide.
Exactly.
Hey, I'm gonna shoot for the stars here. So we do have a few times when people do take those out of consensus forecasts.
We've had some people on say, all right, multiples stay where they are. So we're just going to purely do the S&P advance based on earnings per share growth for the next 12 months. What do you think we can do there? Double digits?
Well, I think in that case, could we get 8 to 10%? Certainly. With the Mag 7 slowing down, as we see every year, it's slower, but still in the high teens or low 20s. But we see PE compression because they're over 30. I mean, let's take Tesla's side, which is like 200. The others are, 30 for companies that are growing 20% a year, even with a decelerating growth, is not what I call a bubble. So I'm not going to predict that, it's going to last forever. I'm not going to predict there won't be disappointments of Mag 7. But I've been saying all along that those have been calling this a bubble or saying this is, 2000 have not really been looking at the facts behind the figures.